Today's guest sold Shout.com, Kosher.com, and Silver.com all within the past year. He also has a history of selling revenue-generating websites in the 6 and 7 figures range. How did he get the attention of the buyers to make all these sales? Stay tuned. I have 3 short sponsor messages before we get into today's show. First, if you have a great domain name and nothing to show when people visit, you're missing out on potential advertising revenue, leads, and partnership opportunities. NicheWebsites.com can build you a site quickly with a price option to suit any need. But as their tagline says, they don't just build websites, they build businesses. Second, if you're buying or selling a domain name or a portfolio and you want an estimate of its value, Estimate.com is the place to go. Just like you'd visit Zillow.com to get an estimate of a house value, Estimate.com provides key information about the most important statistics so you can make an informed decision based on data. Finally, DNX.com is a domain name exchange that uses a reverse auction platform to provide fair market prices for quality domain names that are manually filtered by an experienced broker. At DNX.com, domain prices drop until someone decides the price is right. But don't wait too long or the domain you love might be purchased by someone else. All 3 sponsors have a clickable banner in the upper right-hand corner of DomainSherpa.com. Here's your program. Hey everyone, my name is Michael Seiger and I'm the publisher of DomainSherpa.com, the website where you come to learn how to become a successful domain name investor and entrepreneur directly from the experts. Today's guest sold Shout.com, Kosher.com, and Silver.com all within the past year. Phenomenal domain names. How did he get the attention of the buyers to make all these sales? And how does he get the attention of the acquirers of the website properties he regularly sells in the 6 and 7 figures? We're going to find out now. Joining us is David Fairley, founder and president of WebsiteProperties.com, a brokerage that specializes in selling established website businesses and internet business opportunities. David, welcome to the show.
Thank you very much. Glad to be here.
David, I want to find out how you first started selling websites. In the pre-interview, you told me that it started with a website that you created. What was the first website that you developed, and what purpose did it serve?
Well, I got online in 1997. I had been importing hammocks for a number of years, and when the internet came along, I got on pretty quickly just because it seemed like the next wave, which I was happy I had started. I ended up acquiring the Spanish name for hammocks, which is hamacas. Initially, around 2000, I ended up acquiring hammocks.com and the English version. So I had both of those, and I ended up running that site for 5 years total. Ended up selling that in 2002. And so I got my first taste of exact match premium domains with my own site right out of the gate, which was really was quite beneficial having that name.
Yeah. How big did you grow the business during those 5 years that you started it to when you sold it?
Actually, it started off pretty modestly, but it seemed to double every year. When I exited it in 2002, the site was averaging about $150,000 a month in the high seasons. And I think my gross sales were close to $1 million when I sold it, and so I ended up having a pretty successful exit. It was actually high 6 figures. There was a an earnout that was in the agreement, but I never realized that. I think that was intentionally in there, and that was probably what encouraged me to move into the brokering field to begin with, because I felt like I needed to represent people so they wouldn't experience the same thing I did.
Yeah, and I want to ask you about that because when I've sold a company in the past, I too had a broker, and it was a phenomenal experience. So I want to dig a little bit more into that. So when you sold, it was about $1 million business. You say gross because I assume that that you had a lot of expenses. You had to import the hammocks, you had to package them up, and you had to ship them out to the potential buyers. You had some returns, you had customer service, all the things associated with the business. How much profit was the business generating per year when you ended up selling it in 2002?
The business had a net profit margin around 35%. So it was, it was netting around 350,000.
Yeah.
It was pretty significant. I mean, when you sell a business, it's not based on gross sales, because you can be running a business and making millions of dollars in gross and still being, in the red. It really comes down to how profitable the business is. So that's what it was based upon, and that's typically what you're basing a business valuation on. It's a net profit, not
So
the
you,
gross.
you had hammocks. It's a great niche. I've wanted a hammock all my life. I don't have two trees that are close enough to hang one, but I've thought about installing some posts. You had the exact match domain, which I want to know how much you paid for. Let me get back to that. You were generating $1 million in sales gross, about $350,000 per year in EBITDA, earnings before income tax, depreciation, and assets, or profit. Why did you decide to sell the business? It sounds like a great lifestyle type business.
Well, as I mentioned, I had been importing hammocks prior to that. I actually started that in around 1992, and it started off pretty humbly, flogging them at music festivals, and that hippie lifestyle. It was pretty fun, and then it got into mail order, and then of course with the internet, it was the next step. So I think it was just that I had been doing it for so long. I wanted to change. I think that just getting bored. I had 5 years online pretty much, and it had gotten to a degree where I think that at the time I was more than I could manage personally, and I just wanted to change. I mean, in hindsight, probably timing wise, I could have wrote it out for 2 or 3 more years and had a much bigger exit. But after that, I realized too, once you've done one thing, there's infinite opportunities to do that. And I went on to, over the years, I've owned over 65 websites, either developed from scratch or bought and built up and sold. So, I mean, that's what kept me interested. I think I'm just the type of entrepreneur that, like a lot of my clients that like to, create, they're creative and they like to develop new ideas, and holding on to something forever isn't really my style.
Yeah, it makes sense. So, with about a $350,000 net profit on the trailing 12 months, and you said that you sold it in the high six figures. It sounds like it was a multiple of EBITDA of about 2 to 3 times. Is that?
Yeah, there was, it was designed, again, the purchase agreement was, I was supposed to have a 5%, more or less a 5% earnout, but the way it was drafted was cleverly disguised as a way of not, I think in the end, not paying me out as I should have been. And, not to cry over spilt milk. It was I was just out negotiated at the time. I suppose if I had a bit more experience, I would have done it. The way I do it now is, what I learned was that you need to, if you're going to have an earnout, it's either an earnout on gross as a percentage of gross, because you can't really manipulate gross. Gross is gross, and it comes right off the top. And we've done some great deals for clients over the years with that. If you wanted to get there's a higher upside if you can get that. It's not always a cash deal. Sometimes there's owner financing, which is based on a fixed number. But that was sort of what compelled me, was that I realized after the fact that there was no intention really, or they weren't going to pay me, as it turned out. And so I kind of realized that I got the wisdom from that experience, and that's what I pass along to clients. In the long run, I just would never do a deal unless it's very, very cut and dry and simple, and it has to be with the right company or the right player. You can't, earnouts aren't for everybody.
Yeah. And did you actually use a broker when you sold hammocks.com?
Well, initially, what happened was I did retain a couple people, and one of them was just a cutout scam. I got to pay $5,000 up front, and they were absolutely unqualified, and they didn't do anything for me. They said they had a list, and another person just didn't have any understanding of the fundamentals that were unique to internet businesses, and no one at the time, really back then, 10 years ago, really had a clue.
Right.
And because of my background in business and finance and just my own experience, I online, I pretty much knew what the fundamentals were, and over time that's become sort of the norm. But that I was kind of the first into the space really of evaluating and appraising internet businesses based on not only on the bottom line, but on the fundamentals that have to do with traffic and customer database and SEO and all those other factors that come into play now. So it was a learning experience, and that's it's helped me be an asset to individuals that have businesses that not really sure what how to value, and not to step on any landmines. I mean, that was the satisfaction that I get from my career in the last 10 years, is just helping people not make the same mistakes I did and actually have an exit where they can feel good about it. Because there's nothing worse than selling a really great business and then realizing later on, pardon me, that you didn't get paid out what you should have, or that there was some other upside. So that's just comes with experience, and it's one of the most important decisions people make, as you would know. When you sell your first business that you've built up and it's your baby, you just don't want to make a mistake, because it can be catastrophic. It can cost you hundreds of thousands or millions. And so that became kind of part of my mission.
Yeah. So what was the next site after you exited hammocks.com, David? You started up another site. What was the next website that you developed?
I think the first thing I went into right from scratch was a site called puppetuniverse.com. That was I built that, and I ended up having someone locally that ended up husband and wife that took it over, and I helped them grow that for a number of years, and they ran that for 4 or 5 years. From there, I did a whole litany of sites. I built and sold sites. Just one was dolphinlovers.com. I had a antiquecar.com. I had a bathtoys.com site. I mean, I literally got to the point where I was building these things from scratch and not even really having any business, and pre-selling them to people because that wanted to get in online. The next real big one I had was strollers.com. I acquired that domain, built that site up, got it up did some SEO, and I got it to number one pretty quick. That was an interesting one from a couple standpoints. It was obviously a category killer domain name, exact match. It's a fairly large niche. I ended up selling it to a couple from New York State, and they ran it for a couple of years, and then they came back and they got it up to speed where it was doing a few $100,000 in gross sales. But by that time we got into the when it was I think it was around 2005, 2006, when those kind of domain names, product domains, were really, really valuable, and people were really trying to grapple and grab that asset in those spaces. And they came to me, and they weren't really running it like a full-time business. It was kind of more of a hobby thing, and I put it up on the market, and they ended up exiting for close to $1 million. That was a heck of a deal. They had one of the larger players in the marketplace that was acquiring niche sites, bought it. This was one of those deals where it was a great company. They paid, I can't give the exact details, but they did a cash upfront deal and an earnout that went on for 3 years, and it was a tremendous deal. It was based on gross, but in the end, it was I sold it twice, but it was a different timing. Timing is everything. I mean, initially when I sold it, I did pretty well, but it was a lower. There was no numbers. It was just a site that had been developed, no sales. And it was really the domain name at the time and an opportunity. These people got it and ended up probably making, I think that in the end they made 7 or 8 times as much as I did after a couple of years, mostly from the domain name because it was a hot market. So the main thing was that they had developed the site, and the site was up on the first page for most of the keywords, had solid traffic, has what they hadn't realized, a huge amount of profitability, but the domains were so hot at that time, and it just occupied the top spot for major keywords. It was
so it was ranked well, and even though it was doing business, they weren't making a lot of money. It was just a hot market, so it got snapped up. Were they doing affiliate links? Were they doing drop shipping?
they were selling product. Part of the, with a lot of companies, you can't they were excluded from some of the biggest brands just because they didn't have a storefront. Uh, that can pose a problem for any niche seller. If you don't have a retail store, brick and mortar store, sometimes they won't allow you to sell the product line. In the case of the buyer, they were so big and they got all the lines, so they knew that. They picked it up, and I mean, it was a good sale. It was a good buy for them. They did extremely well over the time, and consequently, they were extremely impeccable and honored the agreement, and the client and the seller ended up doing really well over time. So I was really happy with that. But it's an interesting thing because it went from a pure domain name where I bought it for low five figures, sold it for low six figures, developed site with SEO, and then and essentially got to a high 6 to 7 figure deal with the earnout over time once it was developed and actually cash flowing. The timing, I think that the timing had a lot to do with the price.
Yeah,
on that
definitely.
But,
I know a lot of people listen to stories like that and they say, "Oh, that sounds great. I can do that too." Do you think you can buy a single word product category killer domain name like strollers.com today, knowing that the market search engines are so competitive for keywords like that? And do you think you could build it out and get it ranked and try and move a 5-figure purchase to a 6-figure purchase today? Or does that only work, 5 or 10 years ago?
No, I think that I mean, listen, it depends on the ability of the person. I mean, you can build out a category killer exact match domain name, and certainly if you have the skill sets to 6, 7, even 8-figure payout revenue. It just depends. It's not just based on trying to get SEO tactics. I mean, I think that the search engines, Google's devalued exact match domain names, relevancy. It's really content and the product offering relevancy. You have to, if you're going to, having a great domain name is a great asset for sure. It's easy to brand, it's easy to remember, it has all that value to it, and people still can still come in to play from an SEO standpoint. But I think you have to develop a good business, and create brand loyalty, really high customer satisfaction. E-commerce has become very competitive. You just have to. I think the market is still ripe for disruption in certain niches for sure. I still think that 80% of the people out there with these sites are doing a mediocre job. It's not that difficult to develop a site that has great product mix. It just has a really solid functionality and customer service. Those are really important. Having a great name is just a bonus. I mean, it doesn't make or break a business anymore. I mean, you can take a vowel out and have a great name. Now with like sites like LinkedIn and Flickr or whatever the name is, you can, if you do a good job from a business execution, you can make any business huge. But having that great name, it's certainly a wonderful place to start from.
Yeah,
sure.
Well, just a couple of weeks ago, I interviewed the CEO of carloans.com.au, and they migrated from beep.com.au, which was a car financing company. And all they did was change the name, and they increased their business in 5 months from 60 million turnover to 100 million turnover. So,
yeah,
they had a great business before, but with an exact match domain that describes exactly what they do, they were able to lower their customer acquisition costs on Google AdSense and really bump up their total revenue.
Yeah, I mean, I was really shocked when I sold silver.com. I thought for sure there was these companies that I'd seen advertising on television to buy silver bullion companies, and I thought, well, they're spending millions on MSN and Fox, and these things were coming up daily, and I thought, I could never remember the bloody name of the company because it was something that was something silver, and I thought for sure that these companies would see the value in that, and they weren't the ultimate buyer. It was a domain name investor that was planning on developing site, and to this day we're not sure what he's doing. But nonetheless, I mean, you can't, you would think that intuitively a company that was in the market would see that, because it's like a great 800 number, 800 flowers. I mean, silver.com or chocolate.com or whatever it is, you'd think that they'd want that. And, you'd be surprised at how many companies pass on that. But your example of this other company from Australia going from beep.com to this other name is, just shows you the power of a solid domain name can really make a difference.
So you mentioned that you were developing a lot of websites and that you've had a lot of experiences from which you learned, and you wanted to share those with other people that were selling their property so that they didn't have to step on the same landmines. I know exactly, the types we were discussing just before we hit the record button, those kind of events, and I've been through it myself as well. And those are hard lessons to learn. It's hard to, learn, find an opportunity to learn those. You really need a broker. So how long have you been brokering websites for people?
It's going on 11 years now.
Wow.
So, and I've done, I think to last count, it's somewhere around 450 to 500 website businesses sold. We're up, I mean, gross, most of the businesses are probably between 50,000 and 5 million. I mean, the average being somewhere around 250, thousand, over 50 million in gross sales over that time, which, I mean, that's a lot of smaller. I mean, there are a lot of deals in the low six figures, but our market is typically between 100,000 and 10 million. In fact, I get like today and yesterday regularly, we get a lot of private equity groups that tell us that they're looking for businesses that are, that have at least $1 million in EBITDA, and God, I'd love to have, and up to 10 million. So it's not a question of us not having buyers in that range. We just don't have that many sellers that come along that have businesses that are worth more than 10 million. I mean, most of the price range is usually between 100,000 and 5 million, but I have buyers that would sink their teeth into 10 to 25 million range. I mean,
yeah, and that sort of is the sweet spot for institutional investors or private equity companies. They want to see an EBITDA of about $1 million from what I've seen in the past. Is that what your experience is?
They'll look at things that are $500,000 and above, but they're really looking for, they put teams in place. They need to have that cash flow, and
yep.
And they're looking for something that has more solidity and more history behind it, but also the cash flow is important. But we have, I mean, I wish I had more inventory a lot of times in that level. I mean, we have a lot of great deals that are, between 100,000 and $1 million, that range at selling price, but which are great for a lot of buyers and entrepreneurs and investors. But there's certainly, I'm just indicating that it's not like I have 200 million or 500 million dollars overall in gross sales. I mean, it's just an indication
right.
of just having inventory at that level. I mean, in any given day, I could get an email from a seller that has a business that's worth 25 million, and we would have buyers for that. It's not, we have the ability. An internet business that's worth $100,000 has the same fundamentals that something that would have $10 million. It's just a scaling difference.
Sure, exactly. And so if you're doing deals that are, between 50,000 and 5 million, let's say, and your sweet spot is around 100,000 to $1 million, not sweet spot, but the majority of the deals are happening between 100,000 and $1 million. Let's just take a $300,000 deal. If it sells for 300,000, basically their EBITDA is 2/3 or 1/3. I'm sorry, is about 2 to 3 times multiple of their EBITDA is a 2 to 3 times multiple of their revenue. Is that correct?
Yeah, I mean the long term, the average we've seen, most of the deals that we've done I think our long-term average is around 2.85.
2.85, so somewhere around there.
That's actually higher than that, average.
So if it sells for around 300,000, they're doing an EBITDA of the past trailing months, 12 months of about $100,000. Is that fair to say?
Well, 100 to, it can be 100 to 150 is the range. It just depends.
And who are the typical buyers of a $300,000 business?
Well, a lot of time the typical buyer could be an internet entrepreneur that's already been in the marketplace. It can be a husband and wife that have that want to, the husband might be buying the business for his wife, or they might be coming, they might have retired from a career in something else or corporation. It depends. Some people that have gone from brick and mortar that want to invest in a business online. Some of them are looking for investments in businesses that don't take up a lot of time, that they can invest in, that are operating 24/7, don't take employees. I mean, they're looking for what I consider more of a passive income business. There's nothing really passive. I mean, you still have to put time and efforts into it, but it can be done. They can put 2 or 3 hours into it in the evening or in the morning outside of their regular business. There's all sorts of buyers, but I think we have buyers that are high net worth individuals. There's internet entrepreneurs. There's people from the corporate world that are looking for alternative investments outside of real estate or the stock market. You've got private equity, we've got hedge funds. I mean, up to the upper levels, there's internet 500 companies that get our emails, that subscribe, so they want to pick up deals that add to their portfolio, all sorts of things like that.
Gotcha. So, I'm sure a lot of people are listening to the show and they're saying, well, I go to Flippa and I look at businesses that are for sale that are producing revenue as well. How do you contrast your business and the types of businesses that you broker versus those being offered on Flippa?
Well, Flip is an auction based type of setup, so people can kind of come in there. All the information is typically right there, like for you to look at, get access to traffic stats and revenues and things like that. There's no high level due diligence that's involved. Most of the time, a lot of the deals are seem to be under 12 months or a year. They're pretty young. People are trying to turn around. It's called Flippa for a reason. People have built something and they're trying to flip it and get some cash out of it without having a lot of historical proof. So and less due diligence involved. I think they do a lot of good deals get done under 10,000. Some upwards of 20 to 50,000. Some up they get deals closing up towards of 100 and sometimes above. But most of the time, people value those businesses that are. The chatter is 10 months to 15 months of whatever the business has done. Sometimes people try and sell on an average of the last 3 or 6 months. Not a lot of longevity. The type of buyers I deal with are more sophisticated. They're looking for something that's stable and proven and growing, and that has a real history that they can, a lot of tax returns sometimes, so they can get SBA loans on. The typical deal I take that I'll be involved in will take 30 to 45 days to close, versus Flippa is like you're battling it out, trying to bid on something, hoping blindly with whatever they've proven, and then they want to close within 5 days after you're the winner. So it's a different thing. I've bought and sold things on Flippa. It's a different marketplace. There's a lot of naivety that is there, and there's a lot of sharks that exist. So you got to be careful, but there's deals to be had there. I mean, I still use it. It's got a lot of exposure. There's really it's more about exposure than anything else on Flippa, but it's not my market. I have people that buyers on Flippa that complain about the valuations that I have. I'm like, you get what you pay for. People will pay a 3-time multiple or 2.5-time multiple or upwards of a 3.5-time multiple if the business has the fundamentals and the trends and the stability and the elements that buyers want. I mean, in the end of the day, if you buy a business at a 3-time EBITDA, you're getting a 33% return on your money. I mean, and you own the business and it's stable and you've got a customer database and you've got this track record. I mean, that's a better return they're going to get in stocks, and certainly in a lot of times in commercial real estate. So it's a great investment, but there are risks in everything. So you just have to be careful.
Yeah, definitely. So if a person has a revenue generating business and they're listening to you, David, and they wanted to work with you, what's your commission rate for representing a buyer, assuming that you reviewed it and it's some property that you're willing to represent?
Our broker commission is 10%. I mean, that's fairly standard in the in the industry. There's that's a success fee as well. It's we don't get paid unless we sell the business, and that is indicative of how we approach who we work with. I mean, I turn away probably 80% of the people that come to us to sell because it's just there. Our business reputation is such that we, the subscribers or the people that get our business alerts, business for sale alerts, are used to high quality businesses that we've done some vetting on, initially, and that they have solid fundamentals, and they're businesses that I myself like and can get behind. I mean, there's not, I'm not going to try and sell something that's, quite frankly, not worth my time or someone else's. I mean, I have to really, it has to have the fundamentals. It has to have good, solid numbers. It's not falling off a cliff. But I just, it has to be, it has to have the fundamentals that I can get behind and sell and feel good about. So, we are very careful with who we work with. I mean, of course, over the years, we've had a few businesses that have come along where they've turned out to be dogs, or they've in the process of falling off a cliff and start becoming a distress sale. But we don't list typically businesses that are suffering. Unfortunately, people come to you at the wrong time. They're coming, to you. If they come to me and they want to dump the business, it's a dump and run. I'm not interested in selling that. I mean, go and sell it by yourself. I mean, we have people that our buyers are, again, they're more sophisticated. They want to buy a business that they have that has upside and opportunity where they're going to get a good return on their investment and hopefully take to a whole new level. And so that's what we look for in a business. And we're, yes, we've been caught with our pants down a couple of times, but we'll get rid of those listings eventually. We can't, certainly you can't audit people's financials. You have to base it on, there's a good faith aspect, but they have to sign a contract and agreement with us that they're going to present accurate figures, and that this is they have to be transparent in that. And, if they're not, it's going to come out in due diligence, but that's very rare.
Yeah.
We're pretty good at determining whether the business and the business owner are worth our time and our clientele's time on the buyer side.
So you represent a good number of revenue generating websites. You're doing, probably 50 website sales per year. Is that number about right? 45, 40, 50?
It depends. I mean, at any given time, we'll have anywhere from 20 to 25 sites, clients that we're representing at any time. I mean, in a given year, on the slow year, it's 20 to 25, and on the high end, it can be 50, 60 sites. It just depends. If it's not really about quantity, again, it's quality. I mean, I could take on a lot more business. I mean, Flippa has, they'll have 50 to 100 new businesses a day. That doesn't mean they're all good. I mean, there's a lot of schlock on the marketplace. Yeah. And I'm more focused on quality than quantity.
How long does it take to close a deal, and what percentage of the deals that you have closed, David? Roughly.
Our long-term average success is probably 85-90% of the deals that we take on close eventually. The average time to sale, I think, again, when I know we had this, we looked at this before, it was the average site over 10 years, 3.5 months to close. The average in the industry, from what I understand, is around 6 months for online businesses, and then offline brick and mortar can be 15 months. I've had deals that went on the market, and in a day we had offers, and they close in 2 weeks time. So it can be fast. It really comes down to how compelling the business is. If it's a great opportunity, the numbers are good, and the asking price is in the fair market range, it can go really, really fast. And depending on the niche as well. I mean, some businesses people just go cuckoo over, like pet related businesses seem to go really fast. It just depends. I mean, it really depends on the cash flow, on the numbers, there's, when people look, the first thing people look at when they look at a listing is how much is the asking price and what's the cash flow? What's the profit? And they're going to go, okay, well, this is reasonable. or this is a really aggressive, asking price based on the cash flow. What's wrong with this business? I mean, they can, it's a game, but you have to
Yeah.
get people's attention. It
Can you
has to
make
be.
any conclusions about the types of businesses that people are looking for? You said pet related businesses are hot. Is that because a great number of people have pets and they love their pets and so they can understand it right off the bat? Or is it, if I had a business that was, business to business related media that had a fair EBITDA and a decent amount of a fair EBITDA multiple and a decent amount of EBITDA, would people be interested in that? Or is that something that they wouldn't be because they just don't understand it?
No, I mean, I guess, referring to an e-commerce kind of niche. I mean, people like niche sites that they can relate to. I mean, everyone has a pet. I mean, it seems like everyone has a pet. So that those people tend to gravitate towards businesses that they can connect with they can get passionate about. Of course, there's other buyers that are really interested in lead generation businesses or advertising based businesses, media based businesses, things that they can leverage and grow exponentially in different ways that aren't really product related. They have to, e-commerce businesses typically have something that, unless it's drop shipped, you have to handle the product, and you have warehousing and other issues and employees. So it just depends. I mean, for some people that they want something that's more tangible, even though it's a virtual business, they like the idea of something more that they're shipping something. For other buyers, they might like the passive nature of a revenue based model that's based on advertising and content, and others like subscriber based models where there's a every month there's a payment and they can build on that, like a dating site or whatever. There's lots of models out there like that.
So you don't have like a 50% of all the sites you sell are niche related e-commerce where people don't have to, people do drop shipping. You can't make a general statement like that.
I'd say, I mean, on probably long term, I mean, 65% of the sites that we sell are probably e-commerce based. I mean, there's more of those. I mean, there's been AdSense and affiliate marketing type sites, but I'd say 65-70% of the businesses have been e-commerce. It just because there's more people that build sites like that and have built sites like that, and there's more solidity because there's a customer base. Problem with Google's updates, a lot of the affiliate driven content based sites that were reliant on AdSense have just gotten whacked, and people lost their AdSense accounts because Google says you did something, you don't know why.
Who knows? Exactly. So on the e-commerce sites, if you're selling 65% of the sites you're selling are e-commerce related, are they more on the drop shipping side of the business where the owners don't touch any products but have to deal with the customer service, or are they more on the side of they import the products, they store them, and then they mail them out when they get a sale?
It's probably 60-40, 65-35 to something fulfillment to drop ship. So, drop ship being 35 to 40% of the opportunities. I mean, there's a lot of advantages to it it's interesting you mentioned importing, because I imported hammocks, and
right.
It just gives you a lot more margin and a lot more flexibility and uniqueness in the marketplace. If you can import a product line, you just typically the margins are bigger and you have more exclusivity versus buying off a distributor or wholesaler that's U.S. based, that have other clients out in the marketplace selling the same thing. So yeah, there's certainly advantages to that, but then you've got warehousing, you've got fulfillment elements and
Customer
all that,
service and people not happy and returns and all that sort of stuff.
Drop shipping does reduce the overhead and the amount of time that's required, but you still have to have customer service. You still have to deal with returns and things like that, but it's less moving parts.
Yeah.
So for some people that's more ideal.
Yeah.
But the margins can be different. They can be tighter. And also with things that are less expensive, and you've got if someone orders multiple products from you and they're coming from different drop shippers, you can get killed on shipping. So there's things like that to consider as well in that particular market. So
can you make any conclusions about the multiple that a business can command based on the type of business it is, how it generates its revenue? Like, AdSense versus lead generation, advertising versus, a niche e-commerce site? Does that make a difference? Or, if it's a strong business, regardless of how it generates its revenue, it's going to, earn on average 2.85 multiple of trailing 12 months EBITDA?
I think really the biggest factor is that well, there's certainly when you have a customer database, it's where there's reorders, people are buying regularly from you. That's important for long-term value. The way you're getting traffic. I think there's a lot more risk perception out there, and likely so because of for SEO, for organic traffic versus controlled traffic that you're paying for, and you're making you're making a margin on that. That's when you control your traffic, and there's a cost associated with that, and you can scale it infinitely based on your budget, and you're still making profit margin. That is more attractive these days than saying, hey, I've got all this positioning, I've never been hurt, and I don't pay for anything. I mean, that's a risky proposition now to assume that that's going to go on forever. The biggest factor, I think, for increasing multiple, other than just having a lot of history and sort of underlying fundamentals, unique proprietary products or services, or loyalty things, or even subscription based, where there's reordering a history that you can see. Well, this average buyer is worth X amount to me, where you can factor that in, is really the growth trend. When a business is growing 20, 25, 30, 40%, 50% a year, that in itself is going to push the multiple. From my perspective, as someone that appraises businesses, I'm going to look at the overall fundamentals, the bottom line in the trailing 12 net, and I'm going to look at that and go, okay, well, based on these fundamentals, you're probably you're in the average. We're going to fall in this that fair market range for something that's really got solid growth and a trend that has been going for a long time, or is curving upwards. That's going to push. We've done deals where we've gotten up to as high as a 4.5 multiple. It really just depends. I mean, for strong growth now, you can get people to pay 3.5 up to 4 time multiple. And also, if you have a killer domain name with the business that's got that kind of a lot of times when I've got a business that's really, really solid and it's got a really valuable domain name, we often will push for a higher multiple on the cash flow. If it's that's something that I know you wanted to discuss, was the domain name being developed versus on its own. And so when you've got a business that's a really strong cash flow and it's got a killer domain name with it, that usually commands a higher multiple as well.
Okay. And might that push the multiple up by 1 time, 2 times?
Well, it just depends on if the cash flow, if the business is cash flowing $500,000, I mean, if you've got a domain name that's worth, 6 figures, I mean, you're going to push it to where if it's making $500,000 and it's stable or growing, you could probably get a 4-time multiple because and you're going to get that because the domain name's great, and you can justify that, right, versus just getting 3. Or it depends on. That's how I would look at it. If the domain name's perceptually worth $25,000 and you're making $100,000 a year, you can push the valuation, but you're not going to get as much of a bump.
Yeah,
it just depends on the cash flow, how much the cash flow is worth.
And can you make a correlation between cash flow and the multiples? So, for example, if it was, $100,000 business per year cash flow, it might be a 2 to 3 times multiple. But if it was $1 million cash flow per year, you might get 5, 6, 7 times the multiple of cash flow. Is there some correlation there that a higher cash flow business produces a higher multiple in the sale?
It really depends on the business model. I mean, if something's producing, a significant cash flow and it's up in the millions, I mean, it depends. You're going to attract a different buyer. I mean, for example, what we were talking about earlier, like these private equity groups, they've got other people's money. They're going to, if they see something that they can scale and throw money at and build up, a lot of times these guys want to roll together these businesses, and they're going to flip, put it, into a shell company and try and take it up, try and put it on the public market. They might be willing to pay more for it, but more money and smarter people doesn't mean that they're going to pay. They're going to throw more money at someone. It really has to. It depends on the business. I mean, if the business has got higher barriers of entry, it's got it's showing growth, and it's got a business model that can be scaled by more resources thrown at it, and it doesn't have a cap to it, then someone that has a lot of money, like a private equity group that's sitting on 30 million that wants to pay, is going to come in and say, like, you're making $1 million, we'll give you 5 million, which is, that's really on the high end. I mean, look, it's not like the S&P where companies are trading at 19 times price, the PE ratios. That's a total different game.
Exactly.
Whatever.
Hey, David, I've seen companies, I've seen people saying that the valuation should be based off of revenue and not EBITDA or profit or cash flow, however you want to refer to it. Is basing a valuation on revenue incorrect?
Yes. I mean, you can be losing, like I said earlier, I mean, you could be doing $5 million gross and be, losing money.
Yeah.
Really, that doesn't do anything. I had a particular recently, a couple of weeks ago, someone approached me that had a business that was doing. They said in their email, we're doing about $4.5 million in 2012. We're on track to do $6 million, and I was like, wow, that sounds great. When I got on the phone with them, they're on $6 million in sales, and it was in furniture niche. They were going to have $150,000 net, and I was like, what do you do with that? I mean, that is so low, and it's just not even, I only know that that's below, that's like 2.5% margins. It's just,
yeah,
it's just not going to be of interest to anyone. I mean, that's a lot of volume without really any profitability. And you've got to, it's not of interest. I didn't take the deal on because I just, it's just not, I think I was going to have more questions arise from the margins versus, what the sales were. And even though when I dug into it, the more I dug into it, it just looked like a business that wasn't run well. And people want to buy businesses that are run well, that have good solid margins. Like, 15% is a low profit, is a sort of 12 to 15% is on the low end if you're doing a high volume, that's okay. But people like to see something like 15 to 25, 30% profit margin. And the higher the net profit, the better. But buying a business based on a valuation of revenues is really just, you're buying in the dark. I mean, that doesn't mean anything.
All right, let me ask you another one. On Flippa, I see people posting businesses all the time. And, we discussed this Flippa as people, starting up something and trying to flip it. But they'll say things like the business runs itself and the owner, doesn't have to spend very many time or half an hour a day answering emails or something. Is that a red flag? Should people be concerned if it sounds like they've got a golden goose or a goose that's laying the golden eggs, but they're willing to sell it for $10,000. Things don't add up. Have you experienced that in the past as well?
Well, I mean, it really, sometimes it can be a red flag. I mean, I've had a lot of sites that were pure passive sites that I bought and added content to it, and then and they had good SEO position, and they would just get AdSense or affiliate commissions. And I had a snoring website, for example. It was snoringremedies.com or something like that. I can't remember what it was, or I forgot the name. It was a while ago, but I bought it, and I put up some AdSense on it and some affiliate programs with a product, and I just let it be. And I did some, I knew how to do some good SEO at the time. It's not relevant anymore, but it was basically, I did the work initially, and then, just made passive income. So I didn't answer the phone. I didn't have to do much. There are sites like that, certainly, but I don't think there's really truly any passive site. I think if you stop working on a site at some point, it's going to atrophy. I mean, you have to add content and you have to do things to sites. And if it's an investment, some people just get bored. They just let them linger, and they slowly over time they atrophy. But I think that for a particular business model, if someone says they're not answering the phone or doing something with certain business models, I mean, I would definitely want to know, and dig a little deeper. It just depends. I mean, there are sites that are just set and go. People just put on autopilot and work, but I don't think that you can, as a buyer, can expect to spend 10, whether it's 10,000 or 100,000 or a million. You're not going to buy a business and not do anything. You've got to be proactive, and the more you put into something, the more you're going to get out of it, obviously. But you have to be careful with some of these bylines that absolutely you do nothing, and it's like,
Exactly.
you really have to be careful, and you've got to really check the traffic and make sure that they're not redirecting traffic from other sites they have. And I mean, there are scammers out there and unethical people, for sure. And I think ultimately the more information that someone can provide, the more history they can provide, the safer it's going to be. And you can, in due diligence, you need to, if someone's pressuring you to close really quickly when you've agreed to buy something, you should be wary. I mean, they should be able to prove everything they've said, and they should be able to be very transparent.
Yeah,
Transparency is important.
definitely. Hey, David, if we've talked a lot about multiples of EBITDA, right? It's for setting the price. And that, when I sold the company, that was like my company, that was the biggest issue, the biggest, determination of the value of the company. But what if a seller has a list of companies, of customers, a newsletter list, an enormous amount of social media fans? Clearly all of those are used to help drive the revenues, but do they have any value in the purchase price separate from the gross profit that the company is producing?
Well, certainly there's a lot of traffic. Definitely can be useful. It can be useful to the buyer. In other ways. I mean, the thing is that I always question is like, look, you've got all this traffic, you've got all these people. Why haven't you been able to monetize this, and why do you think that it's worth so much if you haven't been able to do anything with it? And sometimes I think the answer is simply they've tried and they haven't been able to, and they're not telling you they're not really telling you. To other people, though, if the traffic in the niche is really targeted, it can be extremely valuable to a certain buyer. But at the end of the day, I mean, people really like, it really depends on what it is. I mean, sometimes, we're not talking, if we're talking 10 million visitors a month, that's going to be very valuable. I mean, there's been sites that were educational and whatnot, but that's going to be valuable to someone, and you can try and come up with some sort of appraisal value of that depending on the niche, certainly. But I always wonder why people haven't monetized that. When you've got that kind of traffic, there's something. If they haven't done anything with it, it's either they're maybe in rare cases they're extremely naive or just don't care. In other cases, they've done something's happened. They've done something. They got penalized by Google and they lost their revenue, and they haven't figured out how to do something with it.
Right.
Or there's just things that you have to be careful. With what how you appraise things. I think most people still want to, when they're paying money, they want proof. They want to buy a concept. There are people that are really experienced and will buy a business, certainly because of the traffic and the quality of the traffic and the niche. But valuing something like that is a little bit trickier.
Yeah.
It really depends on really what it is. But I mean, I think you have to be up in the millions for that to be, make sense. And it might be, maybe it's in video game playing, online gaming, or some sort of niche like that, but that can be translated. Someone else can take it and redirect it and utilize it. But you have to the formula for that is you're not going to get paid millions for that unless it's, something like, we're not talking about Twitter or YouTube or traffic like that. It's obviously going to scale to something just enormous and be monetized down the road. But certainly in those cases, yeah, I mean, if it starts doing that, it's very valuable. It really depends on the niche, though, I think.
Yeah. How do you get revenue producing websites in front of the greatest quantity of qualified buyers?
Well, I mean, first and foremost, we've developed a business over 10 or 11 years as a brokerage where we've got people subscribing, and we just don't have a lot of atrophy in that. I mean, because we're respectful of our clients, our clientele. We don't bombard them with a lot of emails, and what we do send them is valuable to them, and they're interested in seeing those, and that's been going, building over years. We've got over 10,000 double opt-in subscribers, and we just don't see a lot of atrophy in that. So that's the first thing. Secondly, is our website's been around for a long time. It's reputable, and people know about it. And they come there, and we have some search engine positioning. We've suffered for whatever reasons of late in our organic position, but we don't rely on that at all. We actually, there's a lot of big business for sale portals out there, and our listings are in all those. We spend a lot of money on our clients and advertising the premium sections for that for our clients, and that brings in people that are looking in these portals. There's 7 or 8 of them, along with our own listings. And when you see a listing from us, they'll come to the site and they'll see all the other listings. And they also, people that are actively looking, are going to see all of our listings, and they'll start realizing that this company has significant properties for sale that are good quality, and that's how it works.
Yeah, I want to ask you a couple questions about due diligence, David. We mentioned that when you sold hammocks.com, you didn't have the greatest advice from the couple of brokers that you brought on. I had a phenomenal broker when I sold my media company in 2007, 8, and I'd highly recommend it to other people. So my first question is around the brokers. How does a seller know if a broker is competent and experienced to represent their business?
Well, first off, they better, you can tell, I think, pretty quickly when you speak to a broker how well they are familiar with the landscape by what they say. I mean, it's what kind of questions they're asking you. And I think that that's going to be specific to internet businesses, of talking about the fundamentals, about what kind of traffic they're getting, what the niche, what the business model is, what the financials are, where they're trending, what the average price point is of the product, what's the reorder frequency with the business. There's things that you're going to say, you're going to ask what the competition is doing, what makes your business special, as far as proprietary. Do you have special relationships with vendors? Do you have proprietary software that you're running? What's the platform? What are your expenses? If you start asking people questions, if they're not asking you questions about what your expenses that you're running, or how many employees you've got, what do you how much you peeling off for cash flow, there's going to be obvious things. The other thing is how they're going to market the business, who's looking at your business. I mean, you can sit there and the reason for people to come to a broker is because they don't have the experience, they don't have the contact with buyers, and they don't know the type of deal structures that can be done. That's where the experience of a broker is going to come in. A lot of people will sit there, and one of the questions I get from people that are maybe a little more savvy, or they think they're more savvy, is, well, you're at, this broker over here said they'll take 8%. And really it comes down, 8% on $1 million sale might mean, on $100,000 is $100,000 commission. Well, that might, if you get 8%, you're saving $20,000, but that broker might lose you $200,000. So you saved yourself 20 and lost 180 because that broker wasn't able to bring in better qualified buyers, or more buyers, or understand how to negotiate a deal that was better. So experience is really, really important. And I'm not the only broker out there. I have I probably have more experience collectively online as an internet entrepreneur and as a broker than most people out there, but there are competent brokers out there. I think you just need to, it's about who you're going to work well with, and how they market in your business. Is it just, we have an accumulation of high caliber buyers that we've nurtured and been respectful for over a decade. That's really big, and it's across the spectrum. And we also spend a lot of money and time preparing our clients And it is about preparing your clients. You can't go to market and just throw something out there. Sometimes it takes 3 to 4 weeks to get someone prepared to go to market. And preparation is in the prospectus that the information is collated and properly presented with all the information that buyers want to see. And we address 95% plus of the questions that are going to come out, and that's a ongoing moving process. So we continue to try and create robust documentation that allows buyers to act quickly, move through the process and make offers, and that's really important. So it's about it's preparation, it's about marketing, and it's about knowing how to get deals done and what a fair deal is. If people are telling you, if a broker tells a buyer like, oh, I can get you 5 times multiple, some ridiculous number just to get you in the door, and then they come back and ask you to take a 2-time multiple on something, that's not going to be a happy customer. We don't try and pander to someone if they don't. I actually ask people a lot of times what their expectations are. What they understand to be the valuation based on what they've seen or heard. And sometimes they way undervalue what they're doing, and sometimes they're just blue sky kind of thinking, and it's
right. So is it fair, David, if I came to you and I wanted to sell my business, or not to you, I went to a broker and I wanted to sell my business, and they said, I get you a 5 times or a 6 times multiple. Is it fair for me to say, what other businesses have you sold that are similar to mine that you got them a 5 or 6 times multiple, and then for me to actually call those business owners and verify it? Should I be doing that kind of due diligence on a broker before I sign a contract with them?
Well, it's like real estate market. I mean, there's comps out there. You can see internet businesses sell within a certain range, and you can get a sense of what that is. I mean, the market is pretty efficient in working out what the range is. I mean, businesses are more valuable to some people than they are to others, depending what they are. And, it's worth what someone's going to pay. But just like a house down the street sells, that's a 3-bedroom house. If you've got a 3-bedroom house and has similar features and square footage as on the same, it's going to sell within a specific range. Maybe you have a nice deck and better landscaping, so that's going to improve it. But with an online business, if it's, it's going to be similar. If it's an e-commerce business that's trending with has certain fundamentals, and it's trending, it's stable, whatever, it's going to sell, in a certain range, and everything's a negotiation. I mean,
right.
It has to be fair for both parties. I mean, right. In the end of the day, both parties, 2 parties have to come together and agree.
But there's no multiple listing service for businesses online. How do I go and figure out businesses that have sold, what their attributes are and what the sale price was?
Sorry, can you repeat that? I apologize.
No worries. So for houses, in your example, there's an MLS, a multiple listing service, where I can actually go in and look at house prices, what they sold for, what their square footage is, what zip code they're in, what school district, all the things that value a house. But on the business side, there's no MLS, there's no multiple listing service for businesses that have sold, where I can go and look at the attributes or qualities of the business, what their cash flow was, and then figure out what the sale price is. So to your point, how do I go and find out what the comps are for online businesses?
Well, I guess, you can see what the listings are for these things based on their profits, and look at that. And then you can, if you are inquiring, there's basic information that's presented up front. And then if you are actively looking, as a buyer, you're going to get that, you're going to get the prospectus sent to you. As a seller, you don't have, unless you're requesting information and getting that, you're not going to necessarily know, but you're going to have, a range of what these sites are selling for, what they're listing for. I mean, you have, not everything sells for what the asking price is, but there is a range. And so you're going to know that, okay, this site they're asking 325,000, it's doing 100,000. They're asking a little bit more. It's probably, you're going to have to sort of extrapolate a little bit and say, this probably sold between $250,000 and $300,000. And, those questions are the questions that a seller is going to ask a broker. And like, when they ask, what's my business worth, they're going to have an idea, but the reason why they're coming to a broker is they want to they don't want to make a mistake. They want to get the best value they can within that range, and they need someone that has expertise and experience to, to present it in a way that can justify an optimal price.
Yeah, definitely. All right, David, here's the final question for you. What's your advice for a domain name owner that doesn't have any development experience but wants to add value to their domain name? So they want to be, a domain name developer. They want to create a revenue producing business, but they just don't have the experience. They have the great names. What would be your advice for somebody that's willing to invest the time and maybe some resources to go down that path?
Well, there's always there's different ways to approach that. I mean, I think that there's a lot of people that have don't have the skills and don't want to take the time, and that's another thing. So they sit and hold and wait till someone comes to them and makes them an offer, and or they put it in the active market and hope they get some number that's, I think, still to everyone's agreement is subjective. I mean, it's a subjective market. I mean, it's been speculative at best, and it's an ebb and flow. We've seen some really outrageous prices and things that have popped and gone back down and then rising back up again. So it depends on the timing. For someone that wants to develop a name, I'm a firm believer in developing a great domain name. And if it's a product or service based, then if you can develop it, the chances are you're going to make money with this on its way, and it's going to create more value to an end user, especially if you get it up well above what the domain name would be valued on its own. If you're not skilled at that, then you have either you outsource to a company that can help you develop the site, either build it for you, or you find a partner potentially that will come in as an equity partner. They develop and run this thing for you for a stake in the business, and that's been done as well. So you can do joint ventures. I would tend to, if someone's really not confident in developing a great business model, then there's been a lot of success with people that said, look, I have this killer domain name in the insurance business or in the auto business or in this related service thing, legal or whatever it is, and they partner with someone that has the resources, that comes in, develops the business, develops out the model, and probably has I would do that with someone that has some track record. You don't just do that with anyone that says that, and then you get something, you create a contract and do a joint venture, and maybe you say, look, we're going to develop this thing, we're going to split we're going to do 50-50 on the revenues, on the profits, and when we sell it, you have 25% stake in the business overall. So you retain, or whatever, maybe it's 50%. I mean, I would split the revenues and try and retain more equity in the business if I was in that situation. That would be my recommendation. Give more upfront. Someone develops it and starts creating cash flow, then don't be greedy with the cash flow, but retain the overall value, because and the rights to sell. So when you're prepared, and if that particular joint venture partner, give them, they want to buy it, give them first right to acquire you out based on fair market. And that's a really good approach, I think, for someone that wants to do that. Find a partner that really has a skill set, has a track record to create an incredible business model, and go that route. Now, the caveat of that is, here's the thing that people have to know, is that there's sometimes developing a domain name that doesn't get traction and isn't making money can work against you in the valuation. A domain name that hasn't been developed in imagination of a buyer might be worth a huge amount, but once you develop a site, if you fail to execute and it's just making a small amount, people are going to ask you about those numbers and the traffic and customer based things, and they're going to want that data, and then they're going to go, well, how are you getting to this valuation? Because you haven't been able to prove that concept. So I have a domain name like that right now that I can't name, but we ran into that. And so the alternative is that you can just remove the name and repark it if it doesn't execute, I suppose. But for people that are dig a little more, they'll go into archive.org and they'll see that you tried something. So that's It's a little bit of a double-edged sword. I mean, you've got to be confident about that. But I think that in the long run, I think it's worth trying to develop a site, creating cash flow, and building more value. There's a lot more money to be made in the long run out of that than if you execute well, than trying to just hold and hope someone's going to give you a 7-day figure payday on just a name.
Yeah, great advice. If you have additional questions, please post them in the comments below and we'll ask David to come back and answer them. David, if people want to learn more about working with you and they want to contact you, maybe ask you some questions, scope out their business for sale, how can they best get in contact with you?
Well, they can go to websiteproperties.com and our contact information is there. They can also send an email directly to me at dfairley@websiteproperties.com. Just the easiest is just to go to the website. Our phone number is there, our email's there, and they can check out our website, our listings, and I'm happy. We do free appraisals, both for domain names, straight domain names, as also for established online businesses, and so we're happy to do that. And it's a great resource for both buyers and for sellers. You don't have to be in the market to sell right now, but eventually everyone's going to have an exit. So it's good to learn, where you're at, maybe get an indication of, is it time to sell? There's a lot of questions. We're pretty straightforward, and we talk. We're going to talk truthfully to people and tell them what we think. And if someone's at a point in their life cycle of their business where it doesn't make sense to sell at this point, or makes more sense to hold, and we're going to tell them that, and we're going to give them the straight goods on what we figure the business is worth, and then they can determine whether the timing is good for them at that point. But yeah, they just websiteproperties.com and they can communicate to us that way.
All right. David Fairley, founder and president of websiteproperties.com. Thank you for coming on the Domain Sherpa Show, sharing your knowledge of brokering domains and website properties, and thank you for being a Domain Sherpa.
Thank you very much for this opportunity. I've really enjoyed it. Hope it's been helpful.
It has. Thank you all for watching. We'll see you next time.